effective tariff rate against China, effective today, is actually 145%.
Beijing is hiking its retaliatory tariffs on U.S. goods today from 84% to 125%.
President Trump now says he will implement a 90-day pause on tariffs on imports.
China has announced a new tariff of 125% on U.S. imports.
China is refusing to negotiate with President Trump on U.S. tariffs.
245% tariffs on Chinese imports.
U.S. stocks are tumbling for the second day. The Dow is already down 1,000 points after dropping almost 1,700 points.
It's April 2025, and the global economy feels like it's walking a tightrope over a pit of uncertainty. Markets are jittery, trade tensions are escalating, and major economies are showing signs of strain. The question on everyone's mind, is a crash imminent? In this video, we'll explore the current economic landscape, examining the factors contributing to global instability. From the US's aggressive trade policies to China's real estate woes and Europe's economic challenges, we'll piece together the puzzle of today's financial world. Understanding these developments isn't just for economists. They affect jobs, investments, and everyday life. By the end of this video, you'll have a clearer picture of the risks facing the global economy and what they mean for you. Let's start with the United States. On April 2nd, President Trump announced sweeping tariffs, dubbed Liberation Day measures, imposing duties as high as 145% on imports. This move aimed to correct trade imbalances, but has sparked concerns about a potential trade war. China retaliated with tariffs of up to 125%, affecting a wide range of goods. The International Monetary Fund, IMF, responded by lowering its global growth forecast for 2025 to 2.8%, down from 3.3% in 2024. The U.S. growth projection was also cut to 1.8%, reflecting the anticipated economic drag from the new tariffs. Financial markets reacted swiftly. The S&P 500 and Dow Jones Industrial Average experienced significant declines. The IMF's Global Financial Stability Report highlighted increased risks, pointing to high corporate and household debt levels, overvalued asset prices, and the potential for rapid deleveraging in financial markets. As the U.S. grapples with these issues, the ripple effects are felt globally. Next, we turn our attention to China, where the real estate sector is facing a prolonged crisis. For decades, China's economic miracle has been tied to one thing: construction. Cities popped up where there used to be farms, and families poured their savings into apartments, not to live in, but to invest. Real estate became the backbone of both middle-class wealth and local government revenue. But starting in 2021, cracks began to show. Fast forward to 2025, and those cracks have widened into deep fractures. Property giants like Sunac China and Kaisa Group are in survival mode. Sunac is converting dollar-denominated debt into shares, essentially letting creditors take control to avoid collapse. Kaisa, meanwhile, is offloading $13 billion in debt through convertible bonds, giving bondholders a majority stake. In simple terms, these companies are handing over the keys just to keep the lights on. Because in China, the real estate sector doesn't just build homes. It powers about 30% of the national GDP when you count all the ripple effects: construction, steel, appliances, finance. It also accounts for around 70% of household wealth. That means when housing prices stall, or worse, drop, everyday people feel poorer. And when people feel poorer, they spend less. Despite Beijing's efforts to prop up the market with relaxed purchase rules and home renovation subsidies, confidence remains on the floor. Home prices in March 2025 were flat year over year, following 2 straight years of declines. It's not just a downturn, it's stagnation, a dangerous word in any economy. And the damage isn't just economic, it's psychological. Luxury spending, a symbol of China's rising middle class, is plummeting. Major brands are pulling out of Shanghai and Beijing, citing slumping demand. Middle-class families that once invested in second or third apartments are holding back. Developers can't sell new units, banks won't lend, and construction sites are going dark. This spiral is exactly what economists fear. When asset prices fall, debt gets heavier and liquidity vanishes. It's called a balance sheet recession, and it doesn't stop at China's borders. International investors are pulling back. Global commodities, especially steel and copper, are seeing price drops due to collapsing demand. If China's market problem is the fault line, then Europe might be where the ground actually shifts. The region isn't in free fall, but it's definitely off balance. And what happens in Europe has a way of shaking the rest of the world. Let's start with the European Central Bank, or ECB. Its job is to keep inflation low and the economy stable. No easy task in normal times, let alone today. For months now, the ECB has been raising interest rates to fight inflation. That sounds reasonable, but here's the catch. Rate hikes make borrowing more expensive. So while they cool prices, they also risk freezing growth. As of April 2025, Eurozone inflation sits around 4.2%, still above the ECB's 2% target. But growth is crawling. Germany, the EU's economic engine, has seen its industrial output contract for 3 quarters straight. That's a red flag. Why? Because Germany doesn't just manufacture cars and machines, it powers the entire European supply chain. One key reason for this slowdown is energy. Europe's pivot from Russian fossil fuels to renewables and LNG imports came at a cost, literally. Industrial users are paying more for electricity and gas than they did 5 years ago, squeezing profit margins. Small factories are shutting down or moving operations abroad. Now, let's talk about debt. Countries like Italy and Spain have public debt levels above 130% of their GDP. That means for every euro they produce, they owe more than a euro in loans. When interest rates rise, those debt repayments get heavier, which is especially risky for countries with fragile budgets. In 2011, this kind of pressure nearly tore the Eurozone apart. We're not there yet, but we're inching closer. And here's where it gets tricky. The ECB has one interest rate for all 20 Eurozone countries, but each one has different needs. France might want to pause, Greece needs support, Germany needs to keep tightening. This is the fragmentation problem. The idea that one policy doesn't fit all. If the ECB moves too fast or too slow, it risks dividing the Eurozone politically and financially. That could spook investors and destabilize the euro itself. Europe isn't in crisis mode, but it's in a tight spot. And because the EU is the world's second largest economic bloc, any slip-up could send shockwaves through global markets. So, with the US slowing, China sliding, and Europe wobbling, are we staring down the barrel of another global financial crisis? If the US, China, and Europe were 3 shaky dominoes, then this is where we ask the big question. What happens when they start to fall in sequence? Not just trouble, but contagion. Contagion in economics doesn't mean a virus, it means panic that spreads. A financial problem in one corner of the globe triggering another elsewhere. And right now, the global system is showing the kind of stress that could set off exactly that chain reaction. Let's say a US hedge fund, heavily invested in treasury bonds, sees rates spike after aggressive Fed policy and new tariffs. Those bonds lose value. Suddenly, the hedge fund's assets aren't worth what it owes. They need cash fast. So they sell. Not just bonds, stocks, crypto, anything liquid. That triggers what economists call a liquidity crunch, when everyone wants to sell and nobody wants to buy. Prices drop further. Other funds, watching their portfolios tank, rush to do the same. It snowballs. Now the banks that lent to those hedge funds, they get nervous. They tighten lending. Businesses feel the pinch. They can't borrow to pay wages, expand, or restock. And suddenly, a problem that started in one hedge fund has spread into the broader economy. Imagine you're at a crowded party and someone yells, "Fire!" Even if there's no fire, If enough people panic, someone will get hurt in the stampede. That's contagion. The IMF recently warned that financial markets are more tightly linked and more leveraged than at any time since 2008. Many hedge funds are borrowing up to 40 times their capital. That means a 2.5% drop in asset values could wipe them out entirely. They call this systemic leverage risk, a fancy term that means if one big player goes under, a lot of others might follow. But it's not just the US. If China's housing market stumbles further, the banks holding all that property debt could freeze lending. International investors, already spooked, might pull out of emerging markets. Those currencies would fall, debt repayments would rise, and smaller economies from South Africa to Argentina could face real pain. This is how the 2008 crisis spread, not all at once, but in waves. A housing bubble in the US became a banking crisis in Europe, a trade collapse in Asia, and a job crisis almost everywhere. When trust evaporates in one part of the system, it evaporates everywhere. So, with financial institutions more connected, more exposed, and arguably more fragile than before, where does that leave us? So, here we are, 3 economic giants faltering, financial markets tightening, and fears of contagion circling like vultures. The question still stands, is the global economy heading for another crash? Let's take a breath, because the answer isn't simple. No, the world isn't guaranteed to collapse. But yes, the conditions for a global downturn are forming. This isn't just about one economy. It's about timing, interconnected risks, and limited room to maneuver. In the US, rate hikes meant to cool inflation are starting to choke off growth. Consumer debt is climbing while small businesses struggle to afford credit. Meanwhile, the tariff war is escalating, slowing trade and rattling investors. China, on the other hand, is dealing with something deeper. Its property sector isn't just another bubble, it's the engine of household wealth. And when that engine sputters, so does the economy. Stimulus efforts have been weak so far, and consumers aren't spending like they used to. And in Europe, policy paralysis is the danger. ECB's one-size-fits-all approach is tearing at the seams of the Eurozone. The longer this tug-of-war drags on, the harder it gets to coordinate a recovery. So what's the big takeaway? It's not just that bad things are happening. It's that they're happening at the same time and to countries that are deeply connected. In this kind of environment, a misstep by any major player, a failed bond auction, a bank collapse, a sudden currency slide, could tip the balance. But it's not all doom. Policymakers still have tools. Central banks can pause or reverse hikes. Governments can focus on targeted stimulus. And global cooperation, while rare, has worked before, like during COVID-19 and the 2008 crisis. But if there's one truth about global finance, it's this. Crashes don't wait for permission. They don't follow a calendar. And they almost never come from the problem everyone's watching. They come from the one no one sees coming.